So we collected the data of over 10,000 tenants from our properties to see exactly how the U.S. economy is running. This is some of the best boots on the ground intel you'll ever get to see exactly what's going on with the common person. But before we do that, I'm going to go over the differences between what I saw in 2008 for what I'm seeing right now in 2024. 2008, 2009, rents were about $700 or $800 on the average. Depending on the area, they can range from $1,200 to $1,800 a month. Another important point is that the minimum wage in 2008, 2009 was somewhere between $7 and $8, depending on the state. Today, in 2024, we're seeing at least double that. But the most important thing that I think we all need to recognize, the difference between 2008 and today, is the unemployment rate. So the unemployment rate going into 2008 was right around 7%. It peaked up to over 9% in 2009. Today, unemployment is sitting at about 3.7%, depending on who reports it. So that's more than half less. And why that's the most important factor is because the Fed believes that it needs to increase the unemployment rate to about 4.5%, which could be up to 2 million more people unemployed. That will obviously be significant to the economy. The difference, of course, is that in 2008, 2009, we did not have inflation. Today, having high unemployment and high inflation would be a double whammy to the general consumer. One more additional note is that the labor force participation rate, which is an important thing to watch, was about 66 to 67% in 2008, 2009, and now we're sitting at about 63%. Today, we have a low labor participation rate. We have a low unemployment rate, which the Fed wants to increase. And of course, we have a high inflation rate, and people have just been annihilated over the last few years from rising prices. So in 2008, the problem were the homeowners actually lost their houses and actually put pressure on the rental housing, because what happened to people is they fell out of their homes into rentals. And then, of course, there was no construction for a while, which just continued to fuel the fire for the rising rental prices. Today, much different scenario. Low labor participation rate, low unemployment, rising rents, and undersupply of housing. So it's going to be very different for what happens next, is that we're severely undersupplied as a nation as a result of what happened from 2008 to about 2018, when there was hardly any new product built. So in 2008, we did not have a rent inflation problem because demand did not exceed supply. In 2024, it's going to be very different because we are already undersupplied, and the demand of people that cannot now afford to buy a home are pouring into the rental market, putting more and more demand on the market, which is going to create price inflation.
And to talk more about our 10,000 tenants, I brought in Shannon, our Director of Property Management. So what else are you seeing at the tenant level?
We're seeing a great impact on the residents due to the economy and inflation and their ability to pay rent and how they handle their expenses. Working a lot more, doing their traditional job, and then having a night or weekend job where they're supplementing what they're not making or what they need to make above what they used to have to make because of the changes in the economy. We're seeing a lot of our residents coupling up or moving in together. So less demand for the studio or smaller apartment that only one person can live in, looking for roommates, even couples doing the roommate. So, or moving back in with family is a big thing, or renting as a family. And a two-person income right now might not be the most successful or have the most ability to pay a higher rent. So in our portfolio over the last 2 months, I kind of did a review on the numbers, and about 17% of our resident move-out reason is eviction or skip.
So 17%. So how does that compare to year-over-year averages? Like if we were to go back 5 years ago?
Oh, it's definitely quadrupled. I mean, I think the prior was probably a 3 or 4% for an entire portfolio or company like us. So it's definitely increased.
So just to be clear, guys, we had 10,000 units 5 years ago too. So we sold some, bought some, whatever. 3 or 4% of 10,000 is 300 or 400 units. That's kind of generally what we used to do. but now we're at 17%, right?
Yes.
So what that means is there's an additional 12, 13, 1,400 people. That's like 100 a month more that are actually skipping out or leaving or becoming evicted. So this is what we're seeing in our 10,000. So if I was to put this into perspective from 2008, what happened was people lost jobs and the unemployment went up. And so what they did, kind of the same thing. It definitely happened, but what shored it up were all the homeowners actually moving out of homes into the rental side. So we had people leaving, but we also had a lot of demand of the people that were losing their houses. It's not going to be the case now because trying to buy a house is unaffordable at the moment. There's all these programs called Buy Now, Pay Later. I know Apple just rolled one out called Apple Pay Later. So people are starting to finance their debt, including rent, right? And there's a company now that entered the space called Flex,
Yes.
right? So why don't you explain how that works? And we would have never had to use a company like this before, but now it actually helps us.
What happens is Flex pays their full month's rent for them, and they do an agreement with Flex to make multiple payments. They can do anything up to 4 payments in a month, and then that debt is now Flex's responsibility to collect.
There are people, especially now, like the Uber drivers or the side hustle, the second jobs or even third jobs we're seeing, where maybe people get paid at different times. Maybe it's cash, maybe it's weekly, maybe it's that. And they might not have all that whole amount at the beginning of the month. The last thing we really want are late fees.
Right.
We don't want late fees. We just want people to pay on time. So this is all new as a result of what's really going on with the people that are living in our apartments right now.
So what do you see next?
Well, as we spoke about in the beginning, is them having to have multiple employment and or different types of employment than what's been traditional. I think that they're moving away from that regular job and picking up multiple jobs that are kind of at their own free will or when they want to do it to try to maintain the lifestyle in which they become accustomed to.
Yeah, which is, can you imagine the stress and anxiety
Right.
for some of our tenants? It's just got to be horrible, especially if a life moment happens, like a medical or maybe they get in an accident or they need like new tires for their car or something like that.
So many of our population is living on a paycheck to paycheck lifestyle and does not have money in the savings for a rainy day or a tragic event.
We put together a rescue fund that was the discretionary fund for tenants that were having financial problems.
Right. And they applied and it went through a third-party vetting agency to determine who would be eligible for those funds. And we did that to try to save as many of our residents as we possibly
And we did, actually.
We did.
Saved a lot of folks. So let's talk about how people actually move in because, we've been pretty clear on this from the beginning. They fill out an application, then we run a criminal credit background check, and that goes through a third party, right? So we know all the data on these folks. We know how much savings they have. We know how much income they've got each month. And so it's not like we're putting people into our apartments they can't pay. So that's why that 17% is so interesting. Because it used to be 3-4%, now it's 17%. And our standards have
Not changed.
Ours are pretty black and white, right?
Yes.
Why don't you walk through the process?
So we are very clear with our future residents or our prospects regarding what the application process looks like. They're given that when they come in and they apply. We do use, like you said, a third-party agency that has all of our standards, which are across the board and very industry standard. We also just started using an income verification because so many people with these jobs we're speaking of that it's hard for them to verify what their income is. So we are actually now using a program where they can link the information directly to us and we can verify that that is correct, and it can be multiple types of income sources that they can verify on our behalf. So all of this is done by a third-party agency, and this has no reflection of a site team's determination of who can pay and who cannot. We use this program, and what comes back is how we decide to move forward. We do, as a company, allow additional deposits to be paid. So you can be approved, you can be conditionally approved, where you use that e-premium and you buy a little bit larger of a deposit. Or, of course, some applications do come back declined.
So, okay, going back to prior years now, are we seeing more? Number one, are we seeing more applications decline? But number two, we're also seeing a big jump in fraud.
Yes.
In other words, we're starting to see people actually go and fabricate W-2s and do all the stuff and say they have jobs. So all of these things are starting to be new to us, right?
Right.
So what are you seeing in that area?
So for us to be able to stop that or help at least eliminate it to the best of our ability is the rolling out the income verification, where the resident is responsible for uploading the information in, and we have a third party vet out whatever is uploaded into the software and or their bank account and verify that everything is correct and real. Because in a lot of our areas, we are seeing a very high level of fraud regarding income. And we have to combat it with making sure that we're getting qualified residents moving into our communities.
Right. And then in addition to that, we're also seeing a higher denial rate. So in the past, people would not actually even apply because if you know you have bad credit or maybe some kind of a criminal history, and we said, hey, we need you to fill out an application, we're going to run this through a third party, they would just politely not call you back.
Right.
But today, where they're actually running these, just trying to figure out a place to live, right?
Yes, they are.
Very different now. They're actually challenging it and saying, okay, I know I have all these problems, but I'm going to still see if I get in. It's very different. It was never that way just a few years ago.
I would agree with that. Our decline rate is definitely increasing, but you're seeing that due to the challenges of the economy and what people are up against.
Right. And this is the stuff that just doesn't show up in the headline.
Right.
I mean, if you look at the headlines, everything's just fine. Like, I was looking at, what was I looking at the other day? It was like, unemployment's low and that's good, and I was like, well, that's not what the Fed's saying, right? They're saying that that's inflationary. And so you have to look at the other side of the coin. So this isn't all negative. If you take a look at the industry is responding, because the last thing that our industry wants to do is evict people.
Right.
The last thing we want is for people to be displaced from their homes. So things like e-premium for the deposits, things like flex for the rent, those are all tools and resources for our residents so they can stay in their home and take some anxiety or stress off of them so that they can just continue to do their thing. Yeah. Good job, Shani. Nice work. Good clock. Everybody's talking about the office building conversion to apartments. Well, I just did a video on this. You could check that out here.